Hey, thanks for joining us. I'm here with Ted Thomas, who, of course, is the Tax Lien Certificates and Tax Auction Authority. He knows this kind of stuff. And Ted, the question we have right now is, and we've been talking about tax liens, and I know there's tax deeds. What is the difference between a tax lien and a tax deed?
Wow, it's a huge difference. All right, so a tax lien is nothing more than what I'm going to hold up right now. It's just a piece of paper. The piece of paper is attached to the house, and anybody can pay the taxes on that house, and they will then own the certificate. Now, when you come in to pay, you have to pay to get your certificate back. All right, so that's just a real simple. It's a very benevolent investment.
Just to clarify, why would I want to pay taxes on somebody else's house?
Because the return on the certificate is it's outrageous. For example, if you bought a tax lien certificate and let's say you bought it in the state of Illinois, you could earn all the way up to 36% on that tax there. You could earn 3% a month, and the bank's not even paying 1%. All right.
Okay.
So different states pay different amounts. Florida pays 18%. In Arizona, they pay 16%. So you earn a real generous rate of return on that certificate. And it's a very benevolent investment. The people are going to stay in the property. Now, a tax deed investment. Now, this is an altogether different game. Now, this is for the entrepreneurial people. This means when you go to a tax deed auction, when you go there, you're going to raise your hand. You're going to buy a property. But when you buy the property, they're going to start the bidding at 10, 20, 30 cents on the dollar. Now, can you imagine a $100,000 property, and they start the bidding at just the back taxes? Now, why will they start just at the back taxes? The county doesn't want the property. They don't want it. So they're going to discount it. They just want to collect the revenue. The county works on revenue. Every month they want revenue to pay the school teachers, to pay the fire department, to pay the police department. That's what they want. They don't want property. They already own all the property they want. So in one case, it's a piece of paper. In the other case, I'm not going to hold one up. But what if this was a house I was holding up? You get a house.
If you could hold up a house, if you could hold up a house, you'd be the strongest guy in the world, Ted. That'd be outstanding. Nice. I like to see that, but. Okay. I think again that seems pretty simple. So in both cases, the owner can't pay their taxes, and in one state, the state's going, all right, you got to get it. We're taking your house, and so as the investor, I'm going and I'm literally buying their house. Versus the other states, they'll say, okay, you can stay in your house, and I'm paying their taxes for them while they stay in their house and try to get their stuff. Okay, understand a little better. Ted's been filling me in on all this stuff, and there are some really neat investment opportunities in both these scenarios. If you want to learn more, Ted, the best place to go is probably your website, huh?
Yeah, I'd say go to tedthomas.com and look up, tax liens and look up tax deeds. And, I do, a number of minutes on that. We actually even show you examples. I've been doing this for over 25 years, teaching people, and I'm an investor. I'm not just a guy that's here talking about, like late night television. I do this. I buy properties online. I buy in different states. I buy tax lien. I don't do a lot in the tax lien arena because there's a lot more profit in the tax deeds. And I'll explain that as we go through.
Well, that's great. Well, head there right now, tedthomas.com, and you can click on any video you want and learn some more. So, hey, Ted, thanks for sharing with us.